The money in your bank account is not legally yours. When you deposit cash, you legally transfer its ownership and become an unsecured creditor to the bank. This means that in a crisis, the savings you think are safe can be frozen, restricted, or used to cover that bank's mistakes. This single misunderstood fact is the silent risk baked into the entire system. The system isn't broken, it was designed this way. But if the system is designed to fail you, is there an escape hatch? The solution isn't a better bank, but a new kind of money you can truly own, built on a settlement layer called Bitcoin. When you deposit funds, you legally transfer ownership to the bank. In return, the bank gives you an IOU, the digital number you see on your screen. As an unsecured creditor, if the bank fails, you are near the back of a very long line to be repaid. You might be thinking, but my deposits are FDIC insured. And they are, up to a point. The Federal Deposit Insurance Corporation was created during the Great Depression to stop bank runs, today insuring deposits up to $250,000 per depositor, per bank. For decades, this restored confidence in banking. But this insurance creates an illusion of total security. It's a critical buffer, but its limits are exposed when the system comes under stress. The FDIC's Deposit Insurance Fund, DIF, is funded by fees from banks and, by law, must maintain a minimum reserve ratio of just 1.35% against total insured deposits. This means for every $100 of insured money, the fund holds about $1.35. A shock causing even a few large banks to fail simultaneously could wipe that fund out. Furthermore, that $250,000 limit, set in 2008, has seen its purchasing power relentlessly eroded by inflation. What felt like a solid safety net then is a much smaller cushion today. The 2023 regional banking crisis threw this into sharp relief. At Silicon Valley Bank and Signature Bank, over 90% of deposits were uninsured, exceeding the $250,000 limit. If regulators had stuck to the rules, businesses would have lost access to billions, triggering an economic meltdown. To stop the contagion, the Treasury, Fed, and FDIC invoked a systemic risk exception to guarantee all deposits. This saved the day, but revealed a difficult truth. Your protection is arbitrary. It wasn't your right. It was a discretionary choice made by regulators. And if the rules can be bent to protect you, they can just as easily be bent against you. This is the fragility of fractional reserve banking. As long as we don't all ask for our money at once, the system works. But as the 2023 crisis showed, confidence can vanish in an instant. That ad hoc crisis response proved the old playbook was obsolete. In its place, global financial leaders created a new one. For decades, the answer to a failing bank was a bailout, where taxpayer money was used to save institutions too big to fail. After the public anger of 2008, a new plan was forged, the bail-in. It's a quieter method that flips the script on who pays. Instead of taxpayers, a bail-in forces a bank's own creditors, shareholders, bondholders, and even large depositors to absorb the losses. The first brutal test of this regime was in Cyprus in 2013. The country's two largest banks were insolvent. Instead of a bailout, European authorities forced a bail-in. Deposits under 100,000 euros were protected, but at one bank, depositors with more than that had 47.5% of their uninsured savings forcibly converted into bank shares, nearly worthless stock in a failed company. Their cash vanished overnight. The courts later called this a matter of, quote, public interest. This wasn't a one-off event. It became the new international template for major bank failures. The U.S. doesn't use the term bail-in explicitly, but the Dodd-Frank Act of 2010 created the same framework. Title II gives regulators, quote, orderly liquidation authority, where the law is clear. Shareholders and creditors take the losses, not taxpayers. While insured depositors are protected, a pecking order is established. Unsecured creditors, including anyone with deposits over the FDIC limit, are in line to have their claims converted into equity or written off completely. This redefines who is on the hook for a bank's failure. In a major crisis, if regulators choose not to make an exception, the machinery is in place to make depositors pay. The risk of a bail-in only materializes during a failure. But a deeper problem exists in the day-to-day mechanics of the financial system. The very plumbing that can freeze your funds and makes crises more severe. The heart of the problem is settlement finality, the moment a transaction is truly irreversible. When you pay with cash, settlement is instant and final. In digital banking, finality is a policy decision, not a physical reality. An ACH transfer takes days and can be reversed. A wire transfer only runs during business hours. An international payment relies on a slow messaging system called SWIFT. This system of delayed, reversible payments works until it doesn't. In times of stress, its fragility becomes a critical failure point. During the 2008 crisis, the financial plumbing seized. When Lehman Brothers collapsed, counterparty funds were frozen for weeks. In the September 2019 repo market crisis, a sudden cash shortage caused overnight lending rates to spike from 2% to 10% in hours. In the March 2020 dash for cash, even the market for US Treasuries, the bedrock of the system, froze. Each time, central banks had to intervene with trillions just to get the pipes unclogged. This fragility also applies to assets like ETFs. When you buy a gold ETF, you don't own gold. You own a share in a trust that claims to own gold. But the fine print often allows them to pay you in cash during a crisis, not metal. The traditional financial system is a mountain of IOUs. You don't own the underlying asset. You own a promise that can be broken. If the core problem is a system built on breakable promises, the solution cannot be another promise. It must be a system built on mathematical proof. This is Bitcoin. Here's what most people misunderstand about Bitcoin. It is not just digital currency. It is a decentralized, global, final settlement layer designed to fix the core problems of trust, ownership, and finality. First is decentralization. There is no Bitcoin CEO. The network is run by thousands of computers worldwide, all enforcing the same rules. No single entity can change the supply, freeze an account, or alter the transaction history. This leads to its second property, mathematical finality. Unlike traditional payments, Bitcoin transactions are practically irreversible once confirmed on the blockchain. Finality is not a policy. It is enforced by mathematics. Third is permissionless access. Anyone with an internet connection can use Bitcoin. You don't need an ID or permission. It is a neutral network in an age of growing financial controls. Fourth is absolute scarcity. The protocol dictates there will only ever be 21 million Bitcoin, a stark contrast to government currencies, which can be created in unlimited quantities. But its most important property is true ownership through self-custody. When you hold Bitcoin in a wallet where you control the private keys, you are the true owner, not a creditor. A private key is the secret data that gives you the power to spend your Bitcoin. If you control the keys, you and only you can move the funds. This is the ultimate escape hatch. It's the difference between a bank's IOU and a gold bar, but in a digital form, you can send anywhere in the world. The mantra is, not your keys, not your coins. Leaving Bitcoin on an exchange simply recreates the same trust-based model. Self-custody grants you financial sovereignty. Understanding the theory is one thing. Practical steps grant sovereignty. So how do you use this escape hatch to opt out of a fragile system? The path begins with buying Bitcoin on a regulated exchange. For a short time, your Bitcoin sits there. You are still in the old world, holding an IOU and trusting the exchange. The crucial next step is to move from creditor to owner. This is done by withdrawing your Bitcoin from the exchange to a wallet where you, and only you, control the private keys. This is the act of taking self-custody. For serious savings, the gold standard is a hardware wallet, a small physical device that keeps your private keys secure and offline. It signs transactions without ever exposing your keys to an internet-connected device. When you set it up, the wallet provides a seed phrase, typically 12 or 24 words. This phrase is your master backup. It is everything. It must be stored securely offline, never on a computer or in the cloud. Anyone who finds it can take your Bitcoin. By moving your Bitcoin to your own hardware wallet, you cut the cord. Your ownership is no longer a liability on a company's balance sheet. It is a mathematical fact on a global ledger. No one can freeze it, seize it, or bail themselves in with it. You have moved your wealth from a system of institutional promises to a system of mathematical proof. Taking self-custody is the single most powerful action to protect your wealth in the digital age. It might seem intimidating, but it is a skill anyone can learn, and it grants a level of freedom impossible elsewhere. If you want to learn more about hardware wallets and get a step-by-step guide on setting one up, I've placed resources in the description below. Taking back control of your future starts with taking control of your keys. We are at a turning point. The financial system we were born into is showing deep cracks, built on a trust that is now breaking down. It is strained by decades of debt and a design that ultimately protects the institution, not the individual. The modern rules of bail-ins, the fragile settlement system, and the legal definition of a bank deposit all lead to one conclusion. In a crisis, you are the lender of last resort. Your wealth is the raw material used to patch the holes. Bitcoin offers a different path, built not on trust, but on cryptographic proof. It swaps institutional promises for mathematical certainty, offering not an IOU, but final, verifiable ownership. If you understand the architecture of this system, you are already ahead of the vast majority of people. These shifts don't happen gradually. They happen suddenly, under stress. The next crisis is a matter of when, not if. When it arrives, the world may be split into two groups: those who must ask a committee for permission to access their wealth, and those who hold the key themselves. The choice is yours. Subscribe for more on how this new financial world is being built, one block at a time.